All right, good morning. Today is February 15th, 2023. I'm back with another edition of the Wednesday live show, and a lot has happened since last Wednesday. Wow. It seems like last Wednesday was a very long time ago for some reason, but yeah, we got as you recall, last Wednesday, Fed was getting ready to hike interest rates again, which they did, and we'll take a look at that on the chart. It was a wild reaction, as I recall, on the chart, but, you know, up, down, and then Powell spoke, but inevitably, and interestingly enough, I believe the market kind of just settled out, in the same exact spot, and we're going to take a look at this range that we seem to be trading in. So, and then the other big piece of news that got released was the CPI numbers, and that was extremely important because the CPI is what everybody's looking at to figure out if the Fed is going to continue to raise interest rates and when they might stop and where the terminal rate might be. And so the CPI is one of the more important numbers, and it came in a little bit hot, but still down from the previous month. Let's take a look at that. I actually have the pulled up a 5 years of the inflation rate. So the rate of inflation, I believe, yeah, it came in at 6.4, which was a little bit more than expected, but it was down just a tad from the previous read, which I believe was 6.5. And so I mean it's given rise to the talk that everybody now is convinced that inflation peaked, and it's a darn good thing. I mean, an inflation rate over 8% is incredibly bad, put it that way, because as I'm sure everybody knows, every time you go to the store, the prices of stuff that you buy normally have gone up. So here's the thing about this is the rate of inflation, right? And so um, it's a weird number because they like to do a lot of wordplay when it comes to inflation, right? So, this period here looks really good, right? Except for the fact that it compounds, right? If inflation, is 2% year over year, and then the next month it's 2%, and then, and so, like, while this looks, reasonable, I suppose, couple of percent, um, the funny thing is, everybody kind of knew back then that that what am I trying to say here? The official CPI kind of understates inflation, right? I mean, you go to the store, the prices go up, the prices go up. They don't go up for a while and then they go up. Then when inflation kicks in and they start raising prices, that's on top of the prices that, went up during this period. And then once inflation starts kicking up, then all the companies are like, hey, we need to raise our prices to keep up with inflation. And so the costs of everything and so it just stacks up and stacks up and stacks up. And so the if I drew a big arrow on here about the nominal prices of everything, it's just gone up the whole time. Then when this rate of inflation starts to come down, right, the prices are still up here. Like it's not like they're lowering prices of everything. When inflation comes down, the prices are still going to be, as high as they've ever been. And so, I mean, it's rare. There's obviously certain items where the prices come down, but you go to grocery store and they got a buy one get one free sale or something like that. But general price levels in general. I mean, what you're paying for the cost of living continues to go up, and it's going to stay high even as the rate of inflation comes down. That just means that the prices aren't going to increase as quickly and as much as they were increasing before. But I mean, a 6% inflation rate is still a terrible thing. it's awful, you know. Every time I go to the store, and even more recently, you know, with inflation coming down, I go to the store and I see once again, you know, the something that was, you know, two something not that long ago is three something now. And so I think everybody knows what I'm getting at here, but the prices are not going to come down. They just, in theory, hopefully, they're not going to go up as fast, right? And so, anyway, you know, it's kind of a real mess because inflation is just, well, obviously, you know, as they always say, it's a hidden tax, right? So you get less what you pay for, and then you know, of course, there's the shrinkflation. Boy, you really see that at the when it comes to the grocery store and food. You know, the price of stuff goes up, and the packaging gets smaller and smaller. I notice that a lot lately. That you know, certain items are just smaller than they used to be. Well, which you know, maybe that's a good thing, but anyway, so there you go. I mean, that's pretty nasty. The Fed, you know, and obviously all this inflation is a result of the Fed. Well, I mean, we talked about this last week. It's a combination of the Fed reacting to the pandemic crisis, and it's also a function of government spending too, right? So, um, there's a lot of moving parts to it, but everybody, I think inflation is like the one thing everybody in America can agree on is bad. And a 6% year over year inflation rate, you count back 12, you know, you count about 12 months. So, you know, if you had a 6.4% inflation rate, that's on top of, you know, the inflation rate back here where, you know, the price of everything went up, compounded on top of how much it went up there. And so it's a mess. But anyway, speaking of the market, the market itself is in a weird spot right now. And as you can see on this chart, I have a little rectangle drawn around the you know the current price action over the last couple of weeks, last few weeks, um, and it reminds me of back here, right? Actually, I meant to do this on the SPX. Let's do that because it's more interesting on the SPX, and I'll tell you why. Is you got this little consolidation, you know, couple of weeks of just chopping around in this range here, and you know, I didn't realize I had the SPY on the chart before when I drew this. I'm choking on my coffee this morning. What makes this so interesting is that, there you go, is that it's like at the same level, right? You know, just below 4,100 to just up to almost 4,200. And so over here, you know, it's just below 4,100 to almost up to 4,200. And as I recall, that was an extremely tedious trading range for a while there, right? And so, you know, obviously we had a big sell-off and then we bounced up and then we consolidated at that level. And then, boy, that drop out of that level, ouch, that was nasty. And so we've done something very similar out of here, or similar here, except for, you know, the approach to this consolidation is basically more of an uptrend. So hang on, let me get my little trend line drawing tool here. There we go. So, you know, we got this pretty solid upward sloping trend line here. And quite honestly, this little box here is it's kind of shaping up like a bit of a bull flag. So I think you know, it's amazing this rally that we've had here, you know, especially since the beginning of the year, has got a lot of people extremely excited. And you would think that, you know, the market's pushing new all-time highs based on sort of the sentiment that we've seen since the beginning of the year with the rally. And quite frankly, it's rallied back up to like this congestion level. You can see over here there's kind of there's another little bit of looking at my different here we go. This congestion area here. I mean, that was just kind of a pause in an uptrend, but it was around these same levels here, right? So, we're kind of stuck in no man's land here. And zoom out a little further, go back to the beginning of, yes, this is a pretty good reference point because there's the all-time high, right? So, and then of course, there's as long as I got my drawing tools up, we might as well just put this like primary trend line on here. There we go. That's close enough. Close enough right there. So, there's a lot going on here. There's if I move this over a little bit, and what I wanted to do is I wanted to extend this trend line. So, in theory, ignoring all the macro stuff and potential potential problems out there, namely rising interest rates. See, here's the thing is that well, right now I don't think I shouldn't say that, but as long as I've been doing this, I don't think I've ever seen so many sort of conflicting arguments about what to expect and what may happen from here. Because, for one thing, the market's kind of stuck in this little no man's land, but I mean, you can argue either way for, the market rallying up out of here. I mean, technically speaking, just looking at the chart, if that's all you went by, you would theoretically expect that, well, I wouldn't say even expect. You can just look at this and say, well, all right, as long as the price is above that rising trend line, then, the intermediate term trend is up, right? And so we've got, we got this little pullback, and that was a higher low. And boy, you talk about a tedious consolidation period. I mean, that was, but it was right around the holidays, so nobody cared, right? So, but when the market is not trending, when it's not, on a run up or, a run down or whatever, when it's just kind of trapped in a range of, 100, a little over 100 points, boy, it sure is, it seems like everything's really dull. So, I mean, there's a lot of individual stocks that, make moves, and the charts seem to be quite a bit more hectic than they used to be, but anyway, this is a pretty constructive pattern, and I'm not sure exactly what it's going to take to, to break things out of this little flag thing to the upside. But in theory, this consolidation, the latest move that broke the big downward sloping trend line from the beginning of last year, is constructive. The market's sort of consolidating in a bull flag, and so technically speaking, one would expect that this breaks to the upside. And I'm not sure what the catalyst is. That's kind of the odd thing here. There's other ways to draw this too, by the way. This could also look like sort of like a little triangle type thing, but you guys know enough about technical analysis to know that typically when you get these kind of, a bull flag or a little pennant type pattern or whatever, that they tend to resolve in the direction of the prior move, which was up. So, and even if the market were to like sell off for whatever reason, I mean, expectations for what the Fed's going to do now going forward are starting to change too. Everybody is, well, I wouldn't say everybody, the market is expecting a higher terminal rate. I mean, some people are talking about 6% now. The Fed last Wednesday. I mean, that was pretty important what Powell said. And quite frankly, I mean, let's look at what the market did last Wednesday. So that would have been let's see. Last Wednesday would have been February 8th. And so there you go. Is that right? Yeah. Yeah, sure enough. February 8th, last Wednesday. Huh. I would have sort of expected there's a long range bar prior to the Fed announcement, and then there's a long range bar the day after the Fed announcement. And so that's kind of interesting. So yeah, I remember it being kind of a non-event, which was odd. I mean, the market got really volatile intraday, which is to be expected, but it's kind of interesting to see that out of these 3 days, the long range bars were the day prior and the day after the Fed announcement. And so anyway, here we are. We're stuck in this little sort of pattern here. You can see as I zoomed in here, my trend lines need a little adjustment, but there you go. That's close enough. I mean, you get sort of the idea. And so, this move up into this pattern, and now we're just kind of, it's interesting to see like these, lower highs and just this sort of pattern, and it's a lot of inside days, and so yeah, this is just a pure consolidation pattern here, and at the very moment we're like right smack in the middle of it too, right? I mean, just the market's trading like in a little itty bitty tiny range today, right towards the apex of this thing. And so next thing to look for, or we could draw it like this. We could draw like a little bull flag pattern happening here. Same sort of thing. So anyway, the next thing to look for will be a break to the upside out of this. Yeah, retail sales came in a little bit better than expected today. I was reading about the numbers. The funny thing about retail sales is that well, just like with any economic numbers, you got to kind of like really look under the hood, and because they're not inflation adjusted, and then of course they report month over month retail sales. But the funny thing is, all these interest rate hikes have not seemed to really slow the economy. So everybody's talking about, is there going to be a recession? And now I was watching somebody this morning on CNBC talking about a mild recession. So a soft landing and a mild recession, which is kind of funny because, I mean, geez, I mean, a recession can't be good, but if you call it a mild recession, it makes everybody feel better about it. So, and there's a lot of cross currents. I mean, the labor numbers have been really strong, but like I mentioned the past week or two, all these companies are laying off workers, especially the tech companies. Um, One of the big things that the result of these higher interest rates is that like bank CDs and money market funds are paying more than the dividend rate on the S&P, right? And I believe the president's talking about raising tax on stock buybacks. So hey, maybe maybe the S&P 500 needs to maybe the S&P 500 needs to start, getting back to dividends instead of share buybacks, which would be kind of cool to compete with bond rates, right? I mean, if you can get almost, close to 5% guaranteed with no risk on your principal, it would seem to me that over time money would start to gravitate towards treasuries and bonds. And theoretically it could be a win-win because if if you get if you get it close to a 5% risk-free return, as opposed to, the market, which is, as we know, can be extremely volatile and just, drop significantly out of nowhere. That's definitely some competition. And so, that's the old school way of measuring, how interest rates affect everything, because whatever the risk-free rate is, drives money more into locking in a risk-free rate instead of risking it in the market. And so, if you get a risk-free rate that's well above the dividend rate of the market, well then, it's kind of like home prices, right? As interest rates go up, home prices have to come down. It's kind of like a one of those old-fashioned scales with two sides to it, and it's simply because, and of course, these kind of economic trends are extremely gradual, but it's all about the payments, right? So a couple years ago, when mortgage rates were, 3 something%, the payments on the median home in America was like 1,200 and something bucks, and then, of course, home prices went up significantly. But, with mortgage rates where they are now, the median home in America, the payments are, 2,200 or whatever. And so that excludes, just it means that people can't afford more expensive homes. So anyway, it all has to balance out, but it's very gradual and happens over time. So anyway, um, I think my point here, I got off track, but my point is that there's actual competition now for, putting money in the stock market is to lock in, 5% annual risk-free rate. And especially, with retirees, um, back when interest rates were nothing, and you could get, 0.5% or 1% or whatever, locking in your money. I mean, they basically, the Fed forced everyone into risk assets. So, but say you got a, little old lady that's retired now, and she's got $1 million, right? She can get a risk-free return of 5%, which is 50 grand a year to live off of without dipping into her principal or risking, a stock market crash. And so that's kind of that's actually a negative right now. Obviously, higher interest rates typically impact the stock market, but then, there's so many moving pieces of the puzzle, because the stock market in theory also has to keep up with inflation over a super long period of time. It's really the only way to keep up with inflation is to have money in equities. So, and of course, everything depends about the time frame. This is pretty constructive in theory, even if the market's sold down. Let me just take these off of here. Sometimes when you have certain things on your charts, like I could put a 200-day moving average on here, and then that would be another subconscious reference point, which obviously we're trading above the 200. Um, in theory, the market could have a little pullback sell-off as long as it stays above the rising trend line. I mean, it could sell down into this apex here, and it kind of feels like a dip buying environment right now. I mean, it just kind of feels like that. Like we get these little sell-offs, and they don't really turn into much, right? I mean, unless, and of course, if you watch the news and listen to the news and all the crazy stuff that's going on, you would think that, but the market is like really resilient, more resilient than I would have expected recently as far as geopolitics go, right? And all the weird sort of stuff that's happening in the world. I guess you call it the macro picture, right? Markets seems very resilient to whatever news is out there. It seems like all it really cares about is what the Fed's going to do. And quite frankly, I mean, the Fed keeps saying that, they're looking at, a couple of more rate hikes. They're looking at a terminal rate, around 5%. Some are saying 6% now. And and the main thing is that they're planning on holding interest rates, elevated like that. They're gonna, I mean, there's Powell has said many times, and most of these Fed speakers incessantly talking have said that they are planning on holding interest rates at these, at the higher levels for the whole year. And so, it's kind of odd that the market hasn't reacted to that more, but it is what it is. And so, I can't really tell you. I'm not really sure why the market seems to be so resilient in the face of all that, and a potential mild recession. Inflation still extremely elevated, so all the things. But the market is kind of in its. They always said the economy is not the market, so I think it's priced in supposedly. Everything's priced in, so guess we'll have to see. Um, now that we've had this little rally off of the lows, and we're kind of back to these levels where we were. Interestingly enough, let me draw one line. I wanted to draw a line from where we are now to back over here when the market was tanking out of the gate at the beginning of 2022. And so these sell-offs here, like this first main sell-off in 2022 into March, we hadn't seen anything like that since the pandemic. I mean, that was a massive sort of sell-off right out of the gate, and people were freaking out. CNBC was doing markets in turmoil type. That was markets in turmoil type stuff, and it's funny how we've rallied back to like right around those same levels, and even like these levels of consolidation over here. And so, yeah, I mean, the market's kind of gone nowhere year over year. Year over year, it's only down about, well, from over here, it's only down about 5%. I looked at this, I believe I looked at it yesterday. Like what was the 1 year return on the S&P? It was like minus 5%. So um, everything's kind of in limbo. It's kind of like the market's waiting for the next catalyst to do something. And these these little trading ranges are kind of, they get old kind of quick, right? So the other thing is we're kind of in the thick of earnings season here too. So right in the thick of earnings season, and we've got some. We actually have a for the first time in a long time, we got a swing trade that's opened today. We've got several on deck, and now that earnings season's starting to wind down, there's still a lot of upcoming earnings, but now that earnings season's starting to wind down, I think that we should probably start to see more swing trades on deck. So log in, take a look at that. At least we finally have an open trade now. Um, it's hard to say. I can't tell you which way this thing's going to go from here, to be honest with you, because it's one of those things where, like I said, you can argue it either way. It's easy to come up with reasons that the market should go up or should go down, but the difficult thing is that both sides of that make sense. And so maybe this is like a little stalemate. That's kind of almost what it feels like, is that we're like at this equilibrium level, which just happens to be at this same equilibrium level. And then I'm trying to remember what caused that sell-off there. That was either like, really super hot CPI number, or some extreme Fed hawkishness, something like that. But I mean, that was very unusual. That was one of the biggest 3 day sell-offs that I remember. To have a big sell-off, long range day down, and then a gap down and follow through for two more gap downs all the way down there. That was something. And I'm pretty sure that was related to, like, might have been when inflation came in at like 9% or whatever, the CPI reading. So most interesting thing happening right now is the fact that we're consolidating in the very same areas last time, and theoretically this time theoretically this time it looks like, it just feels like it wants to break to the upside, but you never know. But all I can say is that even if we, maybe a little bit of a retrenchment and sell off here, kind of a sell down maybe to this little quadrant here. She's got 4 quadrants going now, which is always, oops, I didn't mean to draw that. It's always kind of interesting when you have 2 lines that converge and cross like this, because what you end up with is 4 quadrants. Right? And so even if we dip down into this one, as long as this rising trend line holds, then you have to assume that the market is acting very resilient. So I guess we just have to wait and see what happens, wait for a catalyst and wait for it to break out of this range. And I think I read somewhere, I did read somewhere, that the second 2 weeks of February are typically, seasonally speaking, are, some of the weakest times of the year. And so maybe we do get a little bit of a sell down at some point, but it seems, on an intraday basis, it seems like the dips, and even when we get, a sell-off of a couple of days, it seems like the dips have been getting bought here lately. And, even back here, we had a couple of little resistance at this downward sloping trend line, a couple of sell-off days, and then right back. And so since the break out of this consolidation around the beginning of the year, money's coming into the market. Someone's buying and driving it up. So whether they're going to pull the rug remains to be seen. And so there's not a whole lot, other than individual stocks. There's not a whole lot as far as the overall market to do, other than just wait for some resolution, wait for a break over 4,200, or maybe a retest around 4,000. But so we'll just have to wait and see. It's kind of a dull environment, but there's a lot of action, lots of action in individual stocks. And so take a look at the stock that, quite frankly, there's a handful of charts that look really good. One of the issues is that there's still a lot of upcoming earnings, and so some of those pending stocks may have to drop off of the list because earnings are going to be coming up. We don't want to buy into something and then earnings are coming out a few days later. So, but anyway, most of the stocks that have released earnings previous to now have settled down a bit, and so we should start to see some more activity. So anyway, thanks for tuning in. I will see you back here next week, same time, same place, and maybe at that point we'll have broken out of this little consolidation area. So I hope so. Anyway, I'll see you next week.